Welcome back. And the gold prices are trading at an all-time high, silver at a 26-month highs, copper at 11-month highs, and you have crude oil prices trading at a 5-month highs as well. So what better time to get Max Layton? He's Global Head of Commodities at Citi, and he joins us right now. Max, hi, thank you so much for joining us here at CNBC India. I want to first start with the Chinese data, and that really seems to be improving. The month of Feb was good. March, more or less, has been on the positive side as well. How do you look at these numbers now?
Look, I think it's a continuation of the trend that we've seen over the last year or so, which is that energy transition spend, energy transition investment in China continues to boom. So the renewable power additions in terms of generation capacity were very strong in the first couple of months of this year. And on the other side of the coin, construction activity has continued to soften. So, we've seen iron ore prices pull back 25 to 30% as a reflection of the weakness in construction activity. And we've seen copper prices, grind higher, and we think move into a higher range as a result of the energy transition demand and some supply issues on the copper side. So it's really, I think, a continuation of the theme that we've been seeing for some time now.
Max, I do understand that Citi has been bullish copper for some time, and we've seen all-time highs in China, 11-month highs on LME, 16-month highs in US for copper. How do you see the smelters output cut reaction in China?
Yeah, so I think a lot of people have been getting very bullish on copper, and you know what? We agree. Right, we've actually been quite cautious and often bearish on copper between May 2022 and the end of last year. So for about a year and a half, we were quite bearish or cautious. But we turned to tactically bullish copper, targeting 8,800 and potentially 9K at the end of last year in early December. And, now we're up at 88.9K. We had a big decision to make. Is copper going to pull back on a rising debt service burden, on a weakening global growth outlook over the next 6-12 months? Or is it going to continue to kind of grind higher, with the range shifting up over time due to underlying deficits and supply issues like those that we're seeing in China with the potential smelter cuts in the next couple of days and over the next few months? We decided that it's going to be the latter. We now think that investors, we're strongly recommending investors have a position in copper, and we're strongly recommending that consumers of copper hedge their exposure over the next 1 to 3 years. It's on a path to 12,000. There's so many different ways to get there over the next 2 years, but that's where it's headed.
All right. So while you're talking about all-time highs in copper in the next couple of years, the ferrous metals clearly have not performed so well. Last year was a negative one. This year, until now, the first quarter hasn't done so well as well. So how would you look at the ferrous metals, and do you see this constant pressure continue?
Sure. Yeah. So iron ore and steel, we're getting down to levels closer to cost support. I don't think we're there yet, but so on the iron ore side, down at $100. And towards the end of the year, the backwardation in the curve takes the price down into the 90s. In prior cycles over the last 4 or 5 years, and certainly based on our cost curve work, you normally get support in the $80 to $90 range. So having fallen about 35% over the last few months, you're around 10% or so away from historical lows in cost support. So we're getting there. We're not sure it's the right time to get in right now, but we're really close, and we think we'll get there down to $90 or so over the next month or in the coming weeks. At which point we think it's going to be a fantastic buying opportunity on the iron ore side. Steel, I think we're more neutral. Range bound market's been range bound for a very long time. We're not really expecting that to change.
I want to come back to the non-ferrous metals, and here the aluminum prices are trading at a 3-month highs. Nickel has been under pressure. Tin continues to take its cues from whatever news comes out of Indonesia. So barring copper, which you are very bullish on, what is your sense on the rest of these non-ferrous metals?
Yeah, I got to say copper's the one that we like. The other ones are underperforming, in part because they're just not attracting the same excitement as copper. So the relative positioning from investors is weighted towards copper. So whenever people think that the world might start to, the Fed might start cutting rates and we might have a turn in the manufacturing cycle, the chosen way to express that view is copper. And it's not the others and coppers. So copper positioning's maybe 6 or 7 out of 10 on the last 5-year range, whereas all the other metals are around 1 or 2 out of 10. Our least preferred metal, so we're most bearish on nickel. We published our quarterly outlook, our slide deck about a week and a half ago, and in that we said that investors and producers should sell nickel at around $18,000. It's come down to around 16,500 at the moment. We think there's more to go. It's going to come down to around 15.5 over the next few months, and that's where we kind of expect it to settle. This market is burdened by substantial supply growth, particularly led by Indonesia. And so we think it's the big underperformer. Aluminium, hey, look, we're medium-term bullish on it, and eventually it's going to have its time in the sun. We're just not expecting it anytime soon. Broadly balanced market. People are not really truly believing in a global recovery en masse, so they're not willing to put on the aluminium leg. They'll put on the fear of missing out trade in copper, but they won't put it on in aluminium, I don't think. But eventually, when global growth does turn, let's call it 18 to 24 months time, there's practically no supply growth in that commodity, and aluminium's gonna have a good run. We think it'll get up to, on a 2-year view, we've got it coming up to 2,900, which is some pretty substantial percentage upside from 2,300. And zinc, largely neutral, trading the range. We're just getting tactically bullish down at 2,300 and getting tactically bearish up at 2,600. And, we'll kind of expect that to be the story of the next couple of years in zinc.
And Max, I do want to talk about the gold prices. All-time highs every single day for last 10 trading sessions. Now we are almost inching to that $2,300 per ounce mark, forgive me. And silver has been surging as well. How do you look at the precious metals from here on?
Yeah, we're loving it too. We're on the bandwagon with gold. I think you only have to go back to the second half of 2007 and look at that Fed cutting cycle when it cut from 5 to 2%, and how gold and silver performed during that period. And we're expecting something of a rerun of that over the next 6 to 12 months. So we've got gold hitting new, fresh, all-time highs, 2,300 an ounce, and we've got silver, even on a 6-12 month view, outperforming gold. Silver doesn't just have the Fed cutting cycle on its side. Silver's also got very strong demand from solar and from EVs coming, led by China, but also globally. So we've got silver getting up to $30 an ounce over the next 6 to 12 months. So certainly we would recommend, dip buying over the next month or two as the market digests this really big inflow of funds into precious metals over the last couple of weeks.
And Max, there's a lot of action in energy as well, especially with the conflict widening now in Middle East, with more countries getting involved, and the crude oil prices are now trading at a 5-month highs. I remember you saying that it's going to be difficult to be bearish in crude. And what is your sense then for prices from here on for the rest of 2024?
Yeah, I think one of the most popular trades or views in the oil market is being bearish volatility or being short vol. And this is a reflection of the lack of fundamental deficits or surpluses, the material deficits or surpluses that people see over the coming quarter. So essentially, people are generally not expecting much to happen, and we're in agreement with that. We think prices are going to be pretty neutral at around the $80 mark over the next 3 months on the Brent side. We think it's a very difficult market to be bearish because of the fact that the situations that you mentioned, and obviously with President Netanyahu saying that he intends to go into Rafah, that suggests that there is a room for material escalation and tension over the coming months, right? So very difficult to be bearish, even if you do have a surplus like we do in our balances in the second quarter. But looking further out, maybe not for the second half, but certainly into 2025, you've got these big structural stories in crude oil. You've got weaker demand growth coming from the cycle, from the global cycle. You've got higher efficiency in terms of automotive use of oil. You've got EVs taking massive market share in China, which is reducing Chinese demand growth. And you've got very broad-based, strong supply growth, especially as prices trade at $80 plus over the next 3 months or so. You're going to have very broad-based non-OPEC supply growth over the next 12 to 24 months. So 2025, we're very bearish, actually. We think that vast bulk of scenarios point to lower prices in 2025, and we have an average price forecast of $60 in 2025.
All right, that's an ouch for the producing countries. But when you talk about 2025, Max, would a lot depend on where the dollar index is, what the US Fed has done until then in sense of rate cuts, with European central banks also talking about rate cuts? How are you approaching the second half of this year?
I mean, I'd say a standout dollar view is we've got dollar-euro going to parity in the second half. When I say we, I mean Citi as a house. And that's essentially on the basis that US kind of outperforms Europe essentially on the growth side, and therefore and on the inflation side, and therefore policymakers cut rates during the second half at a faster pace in the Eurozone than they do in the US. And so that's probably our standout view. I don't think that's going to be a big headwind at all to precious metals, although it does, it takes out some of the upside.
Question, and this one is on agri-commodities. And while everything else seems to be consolidating, it is cocoa which is on fire, up 125% alone in this year itself.
Amazing move in that market. It just shows you what commodities can do when you get inventories down to critically low levels. And reminds me of 2003 in copper when you ran out and the price went up 5 times. Similar things happening in cocoa. Look, my colleague Akash does some great work on ags, and he's been bullish most of the way up. He's staying bullish in the short run. But I think we're more looking on the cocoa side. We're more looking when to get out at this point, because I think there's going to be a lot of opportunity for investors on the way down. Calling the top's very difficult, but we think we're close to a turn at some point in the next couple of months.
All right, Max, thank you so much for talking to us at CNBC-TV18. It's a pleasure as always. So that's the view coming in. Going forward, it's all-time highs for gold and copper. Silver can outperform gold is what Citi says. And when it comes to cocoa, well, selling perhaps is the best here on. But that's all the time that we have on Bazaar. Chartbusters is up next.